All right, we're going to continue the notion of account classification with liabilities. Now, what you'll notice is that liabilities get a very gentle facelift, as I call it, meaning there's not going to be a grand redefinition here. It's still amounts owed by a corporation, but I just added so that it sort of contrasts with the idea of future utility of assets. Think of these as representing future burdens, so just so that it's sort of consistent with that. All right, so in this case, we just have two categories to worry about, so far simpler than our assets, which if they're four and whatnot. All right, so current liabilities and long-term liabilities. So again, the point of demarcation between them is going to be current liabilities are due within 12 months or the company's operating cycle, whichever is greater, and your long-term liabilities are due in more than 12 months. Whoops. Cleaning that up just a little bit there. More than 12 months, or again, company's operating cycle, whichever is greater. Just for the record, you're probably not going to see a company with an operating cycle of greater than 12 months. That means, like from the inception of, let's say you sell tangible goods, the inception of selling tangible goods to collecting on them to reacquiring means it takes more than a year. Yeah, that sounds like a pretty bad business plan that you're working with. So as a rule, 12 months is our line of demarcation that we're going to look at. So in other words, if it's within 12 months, so 12 or less, we'll call them current. So we'll focus on this first. So that would include, obviously, accounts payable, which makes sense. Because remember, when you have an account receivable, you usually tell your customer, hey, you have, typically it's 30 days or less to pay us, pay within that time frame. In the case of an account payable, your vendor is going to say, hey, you have usually 30 days to pay us. So again, that puts it well within the 12 months that we're talking about there. And in the case of notes payable, again, a lot of the typical note is probably going to be due in less than a year. Now again, this is just a switch of perspective. Note receivable was one where you were what? You were the payee, you were receiving payment. In this case, you're now the maker. So you're now the one making the promise. So again, if you're doing this in the context of a corporation, it'd have to be somebody inside the corporate, structure who has the ability to sign on to a note to make it binding, right? They have to have that capacity. Couldn't be just anybody that works there. It has to be somebody that's in a capacity to bind that to the corporation. And we're also going to add to this the concept of unearned fees. Now, these are cash advances received by a corporation for future services yet provided. It could also be for future goods, but we're just going to focus on services for now because that's really what the focus of the class is. So anytime a company gets something in advance and you have yet to provide the service, you have to dump it in this liability account. Now, again, what's the thinking here? Well, what if you don't provide the service to that customer? Then what would you have to do? Refund them the money, right? So that's the reality here. You don't get to just keep it and call it revenue. And remember, this also goes back to the concept of when you get to call something revenue. When it's earned. So obviously, if you've just received the money, but you haven't done anything, you haven't provided the service yet, clearly can't be just dumped in a revenue account. Can't dump it in fees earned. So this is the holding place for any advance payment is this unearned fees account. Now, believe it or not, this is an account that's going to get a lot of, there's going to be a plethora of traffic through this for a lot of businesses because a ton of businesses receive advance payments. Think about this. Anytime, let's say somebody pays, for example, for an airline ticket, we'll assume it's a refundable one, not one of those. It's just like it's a burner. And you pay for it and you haven't flown yet. Well, what does the airline have to do in the meanwhile with that money that you've given them? They have to put it in an unearned account, like unearned airfare or whatever they want to call it. So that's where it's going to sit until you actually fly. In other words, until the flight actually takes place, at which time they will do what? They'll reclassify that as, airline, fares earned. But, not until that happens. Think about magazine subscriptions. Yes, there's still, print media out there. So you pay for a 1-year subscription. Guess what? If you haven't received any magazines, they got to put that in unearned subscriptions in the meanwhile. And every time they send out a magazine to you, whatever the rate is going to be per magazine, they get to now reclassify that as, subscriptions earned or subscription earnings, however they want to title it. So this is a very common account that's going to be used in practice a lot. All right, number two, we have our long-term liabilities. So again, now it's due in more than 12 months. So here, you'll also notice I put notes payable here. Now that would be in a case where you have a portion that's due in greater than a year, and also things like mortgages and bonds payable. Again, in the case of a mortgage, that just means what? Somebody, bought a piece of property and, has 20 years to pay. So obviously, majority of that's going to be in the long-term section because, it's going to take a long time before it actually becomes due. And a bonds payable is just traded creditor equity. And this is usually the case with this concept. Bonds are usually restricted to corporations. Now, the thing to keep in mind here is why you can see notes payable in two places. The current portion of long-term liabilities are going to be reclassified as current when applicable. So in other words, you could literally see this on somebody's books. You could see in two places in the current liability section, you could see notes payable, and once again, you could see long-term liability section, same account. Same thing could be true for mortgages. Any part of the mortgage that comes due within the next 12 months should be reclassified properly as a current liability, because that's the reality there. The company owes it, and it's due within less than 12 months or less. So it's not uncommon to see those accounts sort of be echoed in two different sections and two different classifications, because that's the nature of it. Unlike assets, which tend to be wherever you're classifying them, unless there's a mistake, you're going to keep them there, and you're not going to change that classification anytime soon. The last category here, stockholders' equity, is going to get a very minor revision here. Not much going on here. Mostly what we're doing here is we're just going to come up with separate categories to enable data collection. So this is more or less a review of some things we've already discussed. Again, to enable data collection, you want to think of dividends. Again, that's asset payments to shareholders. Revenues, again, we record these when they're earned, meaning we provided services or sold goods. And expenses, which will be incurred when using goods and services. We want to think of these as being separated, and we will separate them from retained earnings, with the knowledge that all three classifications ultimately affect retained earnings. So we understand that, but we need to separate them. We can't keep them in the retained earnings account because, as I demonstrated in the accounting equation format, it's just, there's just too much happening there. So when you get to the account classification, as we are here, we're saying, no, we're going to say definitively these are separated from retained earnings to enable the collection of data so that we can ultimately do our financial statements, because that's what it comes down to here. So we're going to do a little bit of defining like what we mean by revenue and expense. And revenue is the harder of the two, and expense takes up almost no time at all. So that one will be done fast. So I want to think of revenues in terms of two things, operating and non-operating revenue. Operating revenue means it's the chief source of the corporation's income. That would include fees earned, which we use in here. I bring up commissions as a possibility, although we don't use it, and sales, which we'll also use in here starting with the 5th chapter. Again, that means we use that one for merchandising businesses, but not until the 5th chapter. Right, so the other one, non-operating, means these are incidental to the corporation's operations. So say that fast 3 times. Interest revenue and rent revenue will always be non-operating in this class, but it's not necessarily true in practice. Why? Well, just think about it for a moment. Interest revenue would be a primary operating source of revenue to any lending institution, because that's how they make some of their money, because they loan individuals and businesses money, and part of that loan entails paying interest on it. So that would be revenue to them. So that would be operating, definitely. And what if you were some sort of a leasing company, right? You lease cars or trucks or whatever the case may be. Well, obviously rent revenue would be your primary revenue, so that would be operating. So again, primary, operating versus non-operating, which one of your chief sources is a matter of the context of the business. But in this class, again, you won't see interest revenue or rent revenue treated as anything other than non-operating. And then lastly, with expenses, all your expenses are operating expenses except for interest expense, which we consider non-operating. Now that operating versus non-operating stuff that we're discussing here, we bring it up now, but it doesn't really come into play until later on when we do a sort of a revision of the income statement to something called a multi-step format. So when you see multi-step income statements, then you'll see, oh, I see why we needed that information. So it'll become evident when we get to that. And that concludes the account classification videos. So the next up in sequence for, again, the current section that I'm teaching for this summer, and will be, you should go from this to chart of accounts. And I still recommend that, even though the new version of the book has rearranged things, because it's just a logical progression, as I mentioned in another video. So I'd still want you to do it in that order, but with the foreknowledge that like some of this stuff like we're talking about here isn't going to be actually introduced until the 4th chapter of the new incarnation of the book. But it's actually, again, it's in the correct sequence as it exists right now. Regardless, everything you learn in this end of the class, when it's all added together, gets you to the same place. So pick it up with chart of accounts next. See you there.